In every market, numbers tell a story. In the municipal bond market, those numbers don't just describe price, they describe confidence, direction, and demand. In this episode, we move past the basics of general obligation and revenue bonds and into the analytics and trading mechanics that shape how municipal securities are understood, priced, and sold. Let's begin with the municipal primary market, where new issues are born. When a state or local government needs to raise money, it chooses one of two methods: a competitive sale or a negotiated sale. In a competitive sale, underwriters submit sealed bids. The issuer awards the issue to the syndicate, offering the lowest net interest cost, meaning the best deal for taxpayers. That's the method you'll most often see for general obligation bonds. In a negotiated sale, the issuer works directly with an underwriter to structure and price the deal. This approach is common for revenue bonds, where financing a toll road, airport, or water project requires flexibility, specialized expertise, and a deep understanding of projected revenues. To analyze new issuance activity, professionals turn to the bond buyer, the daily journal of the municipal market. It publishes two key indicators you'll want to know for the exam: the 30-day visible supply, which shows the total dollar amount of new issues expected to reach the market over the next month. A rising visible supply suggests future downward pressure on prices, since more bonds are coming to market. A smaller visible supply indicates a lighter pipeline, often bullish for existing prices. And the placement ratio, which measures how much of the past week's new municipal bonds have been sold by underwriters to investors. A high placement ratio means demand is strong. A low ratio means investors are holding back. The bond buyer also compiles indexes that track average yields across different grades and maturities of municipal bonds. The 20 bond index represents 20 general obligation bonds with 20-year maturities and an average rating of AA. The 11 bond index narrows that to the top rated of those issues, averaging AA+. And the revenue bond index covers 25 long-term revenue bonds with an average rating of A+. Together, these indexes provide a pulse check on where tax-exempt yields are trending. When yields rise, bond prices fall, the same inverse relationship you see everywhere in fixed income. There's also the Bond Buyer Municipal Bond Index, which tracks the average price of 40 actively traded municipal bonds. Unlike the other indexes, which measure yield, this one reflects price, making it an effective barometer for price direction. And finally, the Municipal Market Data MMD curve, sometimes called the AAA curve, charts yields for the highest-rated municipal bonds across maturities. It's published daily and serves as the benchmark for pricing virtually every new issue. Now, once those bonds enter the secondary market, they trade primarily over the counter, not on exchanges, and they're regulated by a specific body, the Municipal Securities Rulemaking Board, or MSRB. The MSRB doesn't enforce its own rules, it writes them. Enforcement falls to the SEC, FINRA, and federal bank regulators, depending on the firm. MSRB rules govern fair dealing, record keeping, political contributions, and how municipal securities are advertised and sold. But perhaps the most investor protective rule of all is MSRB Rule G17, requiring firms to deal fairly, honestly, and with full disclosure of material facts. Municipal bonds are quoted differently from corporates. They're generally quoted on a yield basis, the yield an investor will receive if buying at the quoted price, rather than on a price per $1,000 of par. When a question asks for a basis quote, that's what it means. A bond quoted 4.25 basis is yielding 4.25%. If the yield rises, the price must fall, and vice versa. And when you hear a change of 10 basis points, remember that's 0.1%, equal to $10 per $1,000 bond. In terms of analysis, general obligation bonds are evaluated differently from revenue bonds. For GO bonds, analysts examine the municipality's tax base, debt per capita and debt-to-value ratios, the tax collection record, population trends and income levels. For revenue bonds, analysis is project-driven. Are revenues sufficient to cover operating costs and debt service? What's the debt service coverage ratio, the measure of how comfortably revenues exceed bond obligations? A ratio of 2 to 1 or higher is typically viewed as strong. And here's the larger lesson that connects all of it. Municipal markets are quiet but intricate. They run on confidence confidence in a city's tax base, a utility's revenues, a state's integrity. Every indicator, every index, every yield curve you see is a translation of that confidence into numbers. For exam purposes, know what each measure tells you. Visible supply forecasts future supply. Placement ratio reveals recent demand. Bond buyer indexes track yield levels. The MMD curve defines the benchmark. And MSRB rules define fair conduct. Get those right, and you'll see the muni market the way professionals do, not as a list of acronyms, but as a living, breathing ecosystem of credit, yield, and public trust.